Hey guys, this is John. Just to go over the convertible preferred review for Corning. I would say overall probably a reasonably difficult case. Again, I think a high median on this one wouldn't be that surprising. 19's fine. Again, if it's a little bit higher, that's not that big a deal. Just main thing is, did they write it up well? Did they have coherent thought? Things like that. I think we're fine. I'll kind of highlight a few areas where I would expect they would say something about this, but overall, kind of a tough case. And you'll also notice in my notes, I'm going to stop at a certain point before the end of the notes, but part of it's something that they wouldn't have known about. So I kind of focus a lot on valuing the security. I'm really trying to kind of give them a good review of how the price of a security, especially if it's an alternative financing or these hybrid securities, are really sort of an application of the law of one price, and the fact that if you can figure out the value of other securities, that should apply to this security by combining calls and stock positions and things like that. So overall, I just kind of go through early on here sort of some of the background about what's happening at the company, sort of how they lost. They're starting to lose money now. One of the big deals is they had to write off goodwill because they had made some acquisitions that were not, that they, in hindsight, probably overpaid for. So they wrote off goodwill. And then that sort of reduced their equity relative to their debt, and has now kind of got them into trouble on their debt to asset ratio. So in other words, now if you look at their total debt relative to assets, they're pushing the 60% debt to assets ratio, which was a covenant from one of their previous stock or debt issuances or agreements. So they really are in a little bit of a bind as we look at financing. This kind of goes through the history. It's sort of been a rags to riches, back to rags story. They had a significant increase in their price from 98 to 2000. This helped the company grow internally and through acquisition. And then it fell sharply in 2001. Again, I mentioned before that $5 billion charge that was based on a write-down of goodwill and related to acquisitions. They had that cost was that's kind of put them in a position where their debt to asset ratio is now close to the the 60% threshold of what they can limit themselves to. So the current situation is they need an infusion of capital, and specifically equity capital, and I'll explain more why that has to be the case in a second. So what they need to do at this point is consider issuing a 500. There's this preferred stock, mandatory convertible for preferred stock for $500 million. It offers a 7% dividend, and it has it's guaranteed with a dedicated account of $102 million in Treasury securities. And after 3 years, the security would be converted into equity at a predetermined rate. So now I kind of go through with the class like some of the debt and equity options, like why it's good, and they should talk a little bit about this. And that's one of the questions in the case is why not use debt, why not use equity, and so why not debt rate basically is because of that revolving line of credit's debt covenant doesn't allow them to go over 60. If they add any debt at this point, that's going to put them in potential violation of the covenant, which they want to kind of avoid. So that's why they wouldn't want to use debt. Convertible debt would be a potential solution here, but again, because it's counted as debt, it would hurt relative to the debt covenant. For equity, the problem is that, there's multiple reasons really. The recent results do not give confidence. One question we may have is, are they really adding value? They went and did this massive acquisition spree and haven't really got much to show for it. They went out and raised about $6.3 billion over the last 10 years. You can see this from Exhibit 1. But it really hasn't helped in acquisition. It hasn't helped in any value. And they used it to do the acquisitions, and the stock price is worse now than what it was before they started. So a lot of people aren't confident probably with what's going on at the company. There is a fear of the debt covenant violation, which even if you buy equity might put you in trouble if they default or they are in default of that covenant. And then overall, management itself, not so much investors, but management may feel that they're selling low. So that might be another reason why they're not that interested in issuing equity at this point. So why would we be interested in the security? It really doesn't have anything that's going to help address debt overhang. I mean, again, if it was, I guess you could argue in some ways the convertibility feature would help. We're technically probably not in debt overhang quite yet, but it's kind of at a similar situation. Maybe what they feel like is, hey, if we get this convertible to work out and we can actually delay the issuance of equity, a little bit later, the stock price recovers and we don't have to issue quite as many shares as we do at the price right now. So that would give, maybe it's an indication that management's confident about the future, so they're willing to wait for 3 years. And then to get the same amount of equity capital, the point that I make here is that they'd really, since they're really only going to net 500 less 102, they're going to net about 400 million. If you divide that into 3.15 shares, it's going to be about 126 million shares of common. So they're probably trying to minimize the amount of dilution that they have to have in this particular case. So they go ahead and issue this preferred security that might allow them to push off some of that. Clearly, and another reason for this security could be they're trying to use the disguise the discount on equity, or to minimize the discount on equity. They're trying to disguise it. Maybe that's not good wording. It takes, I don't think that's really a good reason, because I think you have a lot of sharp investors and hedge funds out there that are going to be able to do the math and figure out, like we're going to figure out coming up here, that really it's really kind of an equity issuance in disguise. Can you count on the market being inefficient or inefficiently understanding the security or processing the information? I don't know if that's the case. Now, one thing that might help is maybe they're able to have less delay in being able to raise funds. So, maybe with this kind of issuance wouldn't have to have as much marketing. Maybe they'd be able to get access to the funds sooner. So that might actually be kind of interesting, given that, they wouldn't have to do road shows and stuff like that. If you may have to do a few, but maybe it's more like, hey, if you're interested in buying a preferred security, maybe that would be interesting. So the terms also adjust so that the downward announcement effect of the deal would not affect the total proceeds, and it also wouldn't affect investors' position either, which we'll see later in the discussion. But it might create some risks, and that's what kind of ends up happening in the end. I'll tell you what. At this point, I am going to just come back on my next screen and just talk a little bit about this. Okay, thank you.